Yeah, day 17 of the series. I haven't done this, I haven't done a part in a few days, but we're just continuing on the second chapter's questions. Um, so, yeah, let's begin with question number 17. Look at the futures listings for contracts in table 2.8. Suppose you buy one contract for March 2017 delivery. If the contract closes in March at a level of 4.06, what will your profit be? So this is table 2.8. So March 2017 is this one, which is at 3.96. So if a contract closes in March at level of 4.06, my profit will be 4.06 minus 3.96, which is 0.1. Now typical bushel of corn is like you buy for like $5,000. So therefore the profit will be 10%, which is $500. So that's question number 17 answered. Question number 18 is turn back to table 2.7. Look at the IBM options. Suppose you buy a June 2016 expiration call option with exercise price $150. So let's go back to the table 2.7, which is right here. So June 2016 with a call price 150, which is this one. So as we can see, the call premium is $3.31. So let's type that in. Call premium equals to 3.31. Okay, and exercise price equals to $150. So part A is suppose stock price in June equals to $152. The question is, will you exercise your call? What is the profit on your position? Okay, so if it's $152, then I won't exercise my call because the premium is 3.31, and therefore stock price in June is less than the premium plus exercise price. Therefore thus I won't exercise my call option, or maybe I will, I don't know, because if I see, it's like 153.31, so it's like 1.31, because you've already paid the premium, or have you? I don't know. One second, I need to put this in DeepSeek and check. Expiration. The first question is, will you exercise your call? What is the profit? Second question, you're basically changing the exercise price, so like 155 and 145 and 155. So the key for a call option is that you have the right but not the obligation to buy the stock at the exercise price. Bought June call with exercise price 150. 150. So okay, yeah, so I was right only. So one second. So yeah, in the beginning, the first part, the intrinsic value is $2 minus 1.31. So basically, there's a net loss of equal to whatever that is, 0.69 or something. So oh no, wait 1 second. There's a loss of minus, yeah, so there's a loss of $1.31, not 0.69. Yeah, there's a net loss of $1.31, but you just at that point you're just like minimizing the loss basically, because if you hold and you don't buy the call option, then that is just going to make your situation worse, you know. So yeah, exercise price 145. So this is a great situation to be in, because it will be 145 plus the premium 3.31, which is equal to 148.31, and therefore the stock price in June was 152 minus 148.31 equals to 3.69. So net profit equals to 3.69. So therefore you will definitely exercise call option. So the situation where you don't exercise call option is when the difference between the exercise price and the stock price is bigger than the call premium in a like negative way. So therefore it will be not good for you to exercise the call option. Part C is where if a strike price is 155, exercise price sorry is 155, so it'll be 155 plus 3.31, which is equal to 158.31. So 158.31 minus 152 will be equal to 6.31. So that'll be a 31, yeah. So there'll be a net loss of 6.31. So you won't exercise call option in the C part basically. Now we move on to the 19th question. 19th question is, why do call options with exercise prices greater than the price of the underlying stock sell for positive prices? So what does this mean? Call options with exercise prices greater than the price of the underlying stock. Let me check this. Okay, so this is the answer basically. So the question again was, why do call options with exercise prices greater than the price of the underlying stock sell for positive prices? So the answer is, even when a call option's exercise price is higher than the current stock value, it still holds positive value due to the potential for future gain. This value, known as the time value, represents the premium investors are willing to pay for the possibility that the stock price could rise above the exercise price before the option expires. The more time remaining and the more volatile the stock is, the greater chance the greater the chance of favorable price swing. Thus, more valuable this right to buy in the future becomes. In essence, an out of money call option is priced not for its present worth, but for the opportunity it provides to profit from a future upward move. That's a nice answer right there. Second. Okay, answer 20. Both a call and a put currently are traded on a stock XYZ. Both have strike prices of 50 and expiration of 6 months. What will be profit to an investor who buys the call for rupees 4 in the following scenarios? Profit to an investor who buys the call for rupees 4 in these following scenarios for stock prices in 6 months. Okay, so for part A, what is this? Stock prices in 6 months. Okay. Okay, so investor who buys. Okay, 1 second. So investor who buys the call for 4 rupees be like A. Investor who buys the put for 6 rupees BB. So for part A, stock prices equal to 40 rupees. Okay, so the profit of A will be equal to the exercise price plus the premium minus the current stock price. So exercise price is 50 rupees, so 54. So no, like the stock price minus exercise price minus premium equals to the profit. So profit A equals to stock price currently is 40 minus exercise price was 50 minus call was 4. So therefore profit A will become equal to negative 14, and similarly profit B equals to 40 minus 50 minus 6. So this is even worse, this is minus 16. So in case A, both lose money because the stock price is less than the exercise price, also the premium. Part B, it's so we can do a little bit quickly maybe. Profit A equals to 45 rupees minus 50 minus 4, which is equal to minus 9. Profit B equals to 45 minus 50 minus 6, which is equal to minus 11. So there we have that. Profit A for part C equals to part C, the stock price is given as 50, 50 minus 50 minus 4, so that is minus 4 only. Similarly for profit B, it will be minus 6. And then we do part D, 55 minus 5. Wait one second. Profit A equals to 55 minus 50 minus 4, which is equal to 1 actually. It's pretty nice. So we finally have some profit for A. Profit for B will be equal to 55 minus 50 minus 6. So still in the loss, seems like minus 1. Part E will be 60. So part E will be profit A equals to 60 minus 50 minus 4, which is equal to 6. Profit B will be equal to 60 minus 50 minus 4 will be equal to minus 6, sorry. Minus 6. What? Yeah, 4. Okay. So we are done with that. Answer number 21. Explain the difference between a put option and a short position in a futures contract. So in a put option, you have a choice to sell stock at a previously decided exercise price. Oh wait, one second. I did not check this. 1 second. I think I made a mistake here. So it's a put for 6 rupees. So when the stock price is 40 rupees and the exercise was 50 rupees, so he actually made a profit of 10 rupees. And so he made a profit of 4 rupees. Profit B will be like 4 rupees. And then in the next one also, it was 45, exercise was 50. Okay, in this instance it would be minus 1. Okay, I think so at least. Let me think about it real quick. So it's like 50 rupees is the exercise price, and if it's right now it's 40, you can sell it for 50, gain to 10 rupees, but out of the 10 rupees, 6 rupees is the premium, so you're only getting 4 rupees. So now, okay, now stock is 50. So when stock is 50, 0, so minus 6, that's correct. Stock is 55 minus 11. Stock is 60, it will become minus 16. So yeah, that was an error on my part in the previous question. So in a put option, you have a choice to sell a stock at a previously decided exercise price, and for that privilege, you have to pay an options premium, also decided beforehand. Whereas in a futures short position in a futures contract, you have an obligation to sell regardless of whether you made profit or loss. And for this, because it's a risk, you don't have to pay premium, but you do have to take a leap of faith So yeah, that's pretty much it. Between difference between short positions and put options. I actually didn't know that for the longest time, but I'm happy I do now. Similarly, question 22 asks difference between call option and long position in futures contracts. So similarly, as the previous question, in call options you have choice to buy at an exercise price, uh, but in long positions in futures contract you don't have choice but to buy, and therefore for that privilege you need to pay a premium on the options, not the futures. Okay, that was question number 22. Now we move on to the CFA problems. CFA problems, it's pretty interesting. Schweizer. Firm's preferred stock. Firm's preferred stock often sells at yields. Firm's preferred stock often sells at yields below its bonds because preferred stock generally carries a higher agency rating. Owners of preferred stock have a prior claim on the firm's earnings. No, they don't. Owners of preferred stock have a prior claim of the firm's assets. No, they don't. Corporation owning stock may exclude from income tax as most of the dividend income they receive as a higher rating agency. I think it's option D. I'm pretty sure it's option D, just by like process of elimination. So let me put this question into the DeepSeek just to see. Firm's preferred stock often sells at yields below its bonds because yeah, it was option D only. Dividend received deduction DRD. US tax law allows corporations to exclude significant portion, currently 50% for most ownership stakes, of the dividends they receive from other domestic corporations from their taxable income. This tax advantage makes preferred stocks much more attractive to corporate investors because of this high demand from tax advantaged buyers. Issuing companies can sell their preferred stock at high prices which results in low yield. Yield is pushed down below the yield on the firm's bond, which do not offer this tax benefit. So this was the right question. This was the right answer. I mean, pretty fun. So yeah, let me just put that explanation right there. Okay, second question is, a muni bond carries coupon of 6.75%. It's trading at par. What is the equivalent taxable yield to a taxpayer in a combined federal plus state 34% tax bracket? Muni bond is 6.75% trading at par. What is the equivalent taxable yield? So equivalent taxable yield was R muni. Seconds, formulas. Yeah. R muni by 1 minus tax rate. So that would be in equivalent taxable yield equals to R muni by 1 minus tax rate. So this will mean equal to 6.75% divided by so 1 minus 34%, so 6.75%. So let's take 0.0675 minus divided by 34%. So 1 minus 0.34, 0.66, so 0.06675 by 0.66, 0.102, 0.102 is your answer. Okay, so it's pretty close to 0. Oh, actually, yeah, whatever. So answer 3 is, which is the most risky transaction to undertake in the stock index option markets if the stock is expected to increase subtly. Wait 1 second. Okay, this is okay, I'm tripping. Most risky transaction to undertake in the stock index option markets if the stock market is expected to increase substantially after the transaction is completed. Most risky transaction increase substantially after the okay, so the most risky one out of all these is buy a put option. So buy a put option will be the most risky one out of all these, because it seems like the stock is going to do well, and therefore payoff on the put is way higher than on the call, and also way riskier since everybody hopes and thinks that the stock price will go up. So therefore, if you buy a call option, no, sorry, if you buy a put option on that, it is a risky move. Short-term muni bonds currently offer yields of 4%, while comparable taxable bonds pay 5%, which gives you higher after yield tax if your tax bracket is. So in question number 4, uh, uh, so if your tax bracket is 0, you don't have to pay any tax. Then obviously the what taxable bonds will win, since no tax. B, T equals to 10%. So if T is equal to 10%, equivalent taxable yield is equal to 4%, and 5% is that. So 4 by 0.9, 4.44%. So even in this second part, it's 4.44% is less than 5%. Therefore, taxable bonds will win. B equals to T equals to what is this, 20? T equals to 20%. Okay. And what muni minus 1 by, so that'll be 4 by 0.8, so that'll be 5 equal to 5. Therefore indifferent part C is 20%. What, have we already done that? Well, let's move on to part D and make that C 30%. So T equals to 30%. T equals to 30%. Father makes what am I even saying? I'm so sleepy right now. But yeah, okay, T equals to 30%. So R muni 4 by 1 minus 4 by 0.7, 5.714. So in this case, 100% you would pick muni bond 5.71 greater than 5. Therefore, muni. Got it. Last question for today is question number 5 for the CFA columns. The coupon rate on a tax exempt bond 5.6%. Rate on a taxable bond 8%. Both bonds have par. Watch tax bracket, but then it has to be indifferent to selling goods. So that is equal to 1 minus R muni by R taxable. So indifference rate equals to 1 minus R muni by R taxable. So therefore equals to 1 minus R muni. So that's 5.6% divided by R taxable. What? Okay, let me look that up in DeepSeek. I wrote blonde instead of bond. I'm losing my mind. That's crazy. Is 8%. Oh my god, bhai. I repeated the same sentence twice. Yeah, I really need to get some sleep tonight. The coupon rate on tax exempt bond is 5.6%. And the rate taxable bond is 8%. Both bonds sell at par. At what tax bracket? Marginal tax rate. Would an investor be indifferent between the two bonds? Finally wrote the question down. Yeah, insane sleepiness today. Sorry. So yeah, 5.6% equals to 8% times 1 minus t. So we just like solve for t basically. So we find that the answer is coming as 30%. So let me just write that down real quick. 1 minus 2. Oh, would that work? Yeah, by 8%. 8%, so equals to 5.6%. 5.6% plus 1 divided by 8%, which is equal to 0.08. 11 point, that doesn't work, make sense. Yeah, that doesn't make any sense. Oh, it's not like that. Okay. So I made a little bit mistake in the formula. So it's actually like, yeah, I got it. Okay, now it'll be fine. It should be fine now. So 5.6% is 0.056 divided by 0.08. 0.7, so yeah, 30%. 30% is our final answer. So yeah, we are done with the fifth question as well. So pretty nice, pretty nice. So CFA problems are done. Now we just have questions from the Indian perspective. We have two, and then we have some e-investment exercises. I might do these after dinner, which I'll probably do them after dinner because I have a lot of time after dinner as well. So yeah, I'll finish this chapter today. So yeah, thanks.